A goal without a plan is a wish. You need to take concrete steps. You need a plan. This video is your nudge. In this video, the fourth in our series, we'll discuss more fundamentals on investing, namely how to get started. Hello to all you financial people out there and welcome to Just the Tax. This is my little channel about spreading the good word of financial literacy, so it's more than just the tax. Quick shout out to the folks at the Collegiate Financial Management Association's University of Maryland College Park chapter. Go Terps! I'm making these vids because this is stuff I wish someone would have told me when I was first starting out. And today we're going to talk about how to get started. Let's quickly recap the first three videos in our series. First, we learned about investment fundamentals. Then we learned about risk, volatility, and beta in our second video. And in the third video, we learned about retirement plans. So how can you get started now? Well, as we said in the other videos, commit to learning. Read books and articles from trusted sources. So let's talk about that real quick. I'm a CPA and I'm not trying to sell you anything. These videos are all about my giving back to my community. So I want you to consider the motives of anyone who's giving you advice. So avoid get-rich-quick schemes. If it sounds too good to be true, it usually is. Practice paper trading before putting actual money down. You can do that while you're reading and learning. Build a habit, adopt the right mindset, make sure you have money set aside for rainy day fund, and max out your retirement plans. Do that first. You should set up a rainy day fund that should hold about 3 months worth of living expenses at least. Now, most people don't even have $500 on hand in case of emergencies. Don't let that be you. So commit to setting aside $50 from every paycheck and socking that away, and you'll be surprised at how quickly it adds up. This should go again into some type of savings account. The goal here is not to earn a lot of interest per se, it's that the money should be available to you in case of an emergency. Second thing, either contribute to your employer's 401k, at least enough to get the company match, or set up an IRA plan for yourself. If you're self-employed, like if you've got a side hustle or you're in the gig economy or something like that, look into setting up a SEP IRA. Set up a process where some cash from your earnings is constantly going into a retirement plan with every paycheck. Remember, a smaller contribution when you're younger is far more valuable and important to your ability to retire at all than large contributions when you're older. Third thing, look at investing in things you know about first, things you're comfortable with. And if you haven't yet, take a survey to find out what your risk tolerance is. And once you've got your rainy day fund to a certain point, you can put some of that money into a CD ladder. And this is a really cool technique. It basically bridges the gap between time and interest. So instead of, say, putting $1,200 away into a single 12-month CD, so a 12-month CD would pay more interest than, say, a 1 to 3 month CD. Instead of doing that, you would put $100 away into 12 different CDs, each one offset by a month. Therefore, you're maximizing the amount of interest you can earn, and you're never that far away from your money. So now you're ready. You've got that rainy day fund. You've got that retirement plan set up. You got some money set aside that you can afford to lose. It's not your rent money. Open that brokerage account. Remember, you're looking for a brokerage that's reputable, is in good standing with the SEC and FINRA, and has competitive fees. Then you want to build your strategy based on your risk tolerance, the purpose of the investment. In this case, it's to acquire wealth over time, and you do your research. So some combination of fundamentals and technical analysis. And then you pick your point to start and submit your order, and you're in. Now what to do while you're in the trade? So for most stocks and bonds and mutual funds, the setup in these movements happens over weeks and months, sometimes years. So you don't want to obsess over every little move. Take the long view. Now, some people out there will invest in things like currencies and commodities and options. And for those kinds of investments, you really do need to be watching the market like a hawk. You need to get in and get out within minutes. That's beyond the scope of this video, and I don't recommend it if you're just starting out. You want to start out with something more tangible and understandable like stocks and bonds and mutual funds, and save the more complex investments for after you build your confidence and your portfolio. So now that you're in, you're in the stock market, right? You want to put your stop loss in place, and as the market moves, hopefully in your favor, you can trail that stop loss upward or downward if you're going short. So now, when to get out? Remember, you cannot time the market. Do not fall victim to fear and greed or your ego. Get out when the strategy that you built before you invested anything says to get out. Don't try and grab every penny. Yes, I know it's up so much, it'll go up a little more. Well, you know what? The old adage says, leave something for the next guy. So you get out, you analyze what worked and what didn't, and then you apply that lesson to the next trade. Now, a word about taxes. I am, therefore I must pay. If you earn interest, dividends, or capital gains, you will have to report that income and possibly pay tax. Note that reporting and paying are not necessarily the same thing. Your brokerage will provide you with a Form 1099 sometime between January 15th and March 17th, and you'll need this to prepare your return. In the beginning, your investment returns may be reduced by the taxes and the trading fees that you pay. That's okay. Don't get discouraged. You're building your experience, and that counts a lot. Lastly, a note about cryptocurrency. Oh boy. I didn't mention them in any of these videos because this type of asset is well beyond the basics. This topic deserves its very own video, or more realistically, a series of videos. For now, though, consider that if it sounds too good to be true, it usually is. And from a tax point of view, trading in cryptocurrency can make the preparation of your tax return very complicated. If you have a lot of crypto trades already, get a tax preparer to help you. That's not something you want to DIY. Okay, this will conclude this initial series on Investing 101. We've covered the fundamentals, risk, retirement planning, and steps you can take to get started now. Now, having said that, we've really only scratched the surface. There's so much to learn, and we're going to cover that in future videos. Good luck, and be sure to enjoy that journey. All right, my fellow financial people, thank you for watching this video. Please like, share, and subscribe, and in the comments below, post some requests for topics you'd like me to cover in future videos. In the meantime, may your profits be high, your taxes low, and I'll see you next time back at Just the Tax.